Welcome to Fund in Focus. I'm Brett Winton. With me,
I'm Tom Staudt.
And we are here to talk about ARK Diet ARK. So over the years, as everybody knows, we invest in disruptive innovation. Innovation is by its nature kind of a volatile class of investments to be in. And people have said, well, I really like innovation, but it's so volatile. Is there a way that I can invest without taking on all of that volatility? Well, is there, Tom?
There absolutely is now. And I think Diet is designed to, first of all, make it easy to remember what the tickers are for these funds in ARKD for Q1, ARKI, ARKE, and ARKT, starting in the first trading day of each quarter. But it's also representative of what the fund is supposed to do. I think about this as you would think about Diet Coke, right? If you think about volatility or the potential for some degree of drawdown, as you say, is inherent to innovation, Diet is still the flavor, still full flavor, if you think of it in the soda analogy, but it is with a little bit less sugar, or a little, in this case, a little bit less volatility. And what we'll talk about here is it's really designed to ensure that investors and advisors have more tools to ensure that clients have innovation across their entire client book and not just for a select few.
So what specifically does it do? So DIET stands for Defined Innovation Exposure Term.
That's right. It is. It is an acronym and also representative of what the fund is.
Okay. And what does the actual Defined Innovation Exposure Term do?
So the ARK Diet Suite is really about providing some downside protection to the ARKK, our overall innovation strategy, over the course of a 12-month time period. That's the defined period in Defined Innovation Exposure Term, so the defined term. And each quarter, the fund has a new 12-month period where, based on the performance of the ARKK ETF that people know well for innovation, it modulates the fund's performance if the fund were to finish down over the next 12 months, and that is a fixed participation rate. So if from the time then that quarterly start date, take 12 months later on that date, if ARKK is down, then whatever series, whether it's ARKD, ARKI, ARKE, ARKT, will be down at only 50% of what ARKK is. Now, what is the cost of that downside protection? If ARKK is up 0 to 5%, which of course is less than the historical rate of public equities in the U.S., let alone growth equities, but from 0 to 5%, then the fund would finish zero. It would just finish flat. You don't lose money, you don't make money, it's flat. If it's up, so if ARKK is up more than 5%, then there's a participation rate for the fund that is, it ranges really from 50 to 80%, but really if you look at ARKT, which launched in the fourth quarter, it was about a little bit over 64% participation rate. And the exact specific amount is determined by the options pricing of volatility in the market at that day. So we don't know for sure, but to give you some context, ARKT was about 64, a little over 64%. And that upside's uncapped. And I think that's really important. If you look back at ARKK, calendar year performance, the fund was launched in 2014, so that's not a full calendar year. But if you look at the full calendar years, according to Morningstar or just any performance database, the vast majority of years were positive. But again, we understand that that's a very endpoint sensitive time period.
Sure.
We know that investors and advisors have to allocate capital over the course of a full year. We know that there is volatility in both directions for the general market, let alone for growth equities during the year. And we also know that, drawdowns and the appropriateness or the risk tolerance is different for different clients. And so what I think an advisor should really think about is that for a lot of clients, well, for all clients, their clients have a desperate need for innovation in the portfolio. We've talked about this on a number of our series, on all of our funds, our content. They're dramatically underweight the changes that are happening in the economy.
Yeah.
But we understand that not every advisor, not every client has a return profile, a risk profile that is measured in those 12 months or that can handle the volatility in the short term where there's more uncertainty. This is a tool for that client. If I'm an advisor, I think there's a vast majority of the book of business may be perfect for ARKK, sized appropriately. And in the past where an advisor might say, there's this other part of my book, X% of the book, that this is just not appropriate for. I think they should take a very hard look at one of the ARKD I, E, or T's to say, look at the beta of ARKK relative to, the S&P or relative to NASDAQ. Even in very difficult years, that is more market-like return. And in these positive years, look at that, slightly modulated upside but uncapped. And that's a very attractive participation rate return profile.
So it's like from the advisor's perspective, you get basically half the downside in kind of a 0 to 5 year flat.
Yep.
And then you get more than half, depending on the option pricing,
again,
of the upside. So
again,
it's like,
almost 65 in the last quarter, and that's right. And go back and look at what strong years, when the market had tailwinds and rewarded innovation. And if you look at the performance of innovation relative to the broad market, that is an attractive return profile.
Right. So you mentioned for some clients, this might be actually hey, this is the right vehicle for them to get innovation exposure instead of ARKK. I assume some advisors might actually blend it in the same book, right?
I think some advisors in the cross their book of business, some individual investors, they're going to have multiple, not only of the diet series, but alongside ARKK. I think for clients, whether it's an individual investor who contributes to an IRA or has a brokerage in their 401k, and so they're making contributions on a biweekly or monthly or maybe even quarterly basis, they have the ability now to look and say what part of the cycle we are in. I think probably the most common right now, people talk about, is the market in a bubble, or maybe more specifically, is AI in a bubble? We don't think so.
I have strong thoughts about that.
I was going to say we could spend the entire rest of this video talking about that. But what this and actually it's a great illustration though, right? Let's let the market decide, and also different clients within the same book decide, different allocations within the same client. At the beginning of the year, right, we're heading in the next launch is for quarter one, ARKD. If you're setting an allocation for a client that you're expecting to talk about the next time you do an annual meeting for the next 12 years and you want a certain amount of exposure but with downside protection, ARKD might be an excellent place to allocate a base allocation right now, especially if you don't have any exposure to ARK ETFs. Now, as we go in Q2, Q3, Q4, maybe you want to keep allocating to either back to ARKD. Remember, these aren't only available on the first day of the quarter. These trade every trading day of the year, and you can look at and you can look at the website and other materials for where that is on the return profile chart. So you could still buy one of the ARK Diet funds, a week before it rolls, and it's going to automatically roll again for you. So if you hold ARKD, you have 2026 with a defined outcome for your clients. In 2027, you don't need to make a trade. You don't need to make a taxable event. You can leave it alone. And in 2027, you have the whole next calendar year, and 28, and et cetera, et cetera.
So is there an advantage, though, to allocating at the time that it's pricing?
It is the period that gives you that perfect defined outcome. That's where the defined outcome is set.
Yeah.
From that 50% downside, from that intersection, from that starting point. There are certainly those who are going to look at where we are on the curve and say, this is an attractive profile for me. Remember, options don't price perfectly linear to the move in the interim period. As you get closer to the end date, they trade closer to where the equities are. In the beginning, there's a little less correlation. But where ARKK is from that start date, whether it's from the start of the year to date, if you're talking quarter one, or since the start of Q4, et cetera, you're going to know where that performance is. If it is, strongly up to the right, maybe you like that return profile on the right leg of this trade, and you say I'm on an upward slope that's less than 1. So if it comes down, I'm less than 1. I've got a little bit of a buffer, between that 0 and 5 that'll kick in, especially if we're later in the 12 months. At the same time, you may be perfectly okay with being on a 50% on the left arm as well. So it's really about giving more options.
Generally, no matter where you enter, it should tend to have lower vol.
That's right, absolutely. And I think you look at, that's right. We look at ARKT, the fund since its inception has worked exactly how it would be expected to work. We've seen a little bit of volatility in the market in both directions, actually, since the start of Q4.
I'm aware.
And both sides, it's important to point out both sides, and the product has responded accordingly. I think there are some who may look at where we are, 3 months in and say they want more of a 9-month actually return for ARKT, even as we start this next year. Others clearly are going to benefit more from having a full year outlook, and then obviously as the next quarters come on. But if you're an advisor, if you're a client who has a preset allocation and contributes over time, I think this is a strong option. Also, if you're somebody who is looking at either the end of the year or you're looking at where you think we are in the cycle, maybe you have a base allocation of ARKK and you're going to rebalance that up or down based on whatever your rebalance schedule is, maybe quarterly, semi-annually. And then you're going to take that excess and say, I think right now I'd rather be in a product with some downside protection.
Right.
And maybe 1 month, maybe 1 quarter later, you say, we've had a little bit of a pullback here. This is a very attractive entry spot. I'm going to take that off and buy it into the full ARKK.
And that way you keep the exposure to innovation, but you're able to kind of dial up or down basically like the degree of full exposure you have.
That's right. That's exactly right. And again, I think this is a recognition. The biggest thing that should be taken away from this is every investor needs exposure to innovation.
Yeah.
And, up until the diet suite has been launched, we have strong conviction in ARKK. And if you look at it over the long run, we fully expect that ARKK, if you have a very long time horizon or even a reasonably long time horizon, ARKK is likely to outperform. Yeah. Because we think these are exponential growth opportunities. We think that the companies that we're picking will be rewarded from that over the course of full cycles and that. And so, if you're an investor with that timeline, and that's why I say perhaps a base allocation for those longer term investors, and then use these to complement. If you're an investor that either has a shorter time horizon or if you have a client who doesn't have the temperament for the volatility, right, this is an excellent tool, and that is why we created that. It is honestly not more complicated and not more simple. It is about ensuring that the natural hesitation or reservations about having exposure to innovation are handled with a tool that solves those problems.
All right, lightning round. Okay. Rapid fire. Is there an upside cap?
There is not an upside cap. So in the years where, and ARKK has certainly had those years, and you can look at those, you are participating at that lower rate, but participating through every dollar to the upside.
Yes, all the way to infinity and beyond. Are returns guaranteed?
Guaranteed returns, this is not, but it is guaranteed participation if ARKK finishes down over the 12 months. So the guaranteed participation is set mathematically at 50%. If ARKK finishes down, that is a guaranteed ratio. The up leg, again, we say ranges between 50 and 80. As a good example, we know for sure that in the fourth quarter, ARKT was just below 65%. That gives you an idea. That oscillate. That participation rate, though, is fixed at the first day of the quarter. The participation rate doesn't change as it trades for the rest of the 12 months, but you can buy at any point in time.
Got it. And again, what happens after the 12-month term ends?
It automatically will re-roll for 12 months. And so this is important because you do not have to trade triggering a capital gain or a taxable event if it's in a tax account. Obviously, if this is in an IRA or other shielded account, that's not appropriate or not pertinent. But the fund will automatically roll for 12 more months for you, and then it resets at that axis at the intersection for a new 12-month defined term.
If I'm in ARKK and I want to move it into diet or vice versa, Is that a taxable event?
You would have to sell the fund that you're in to move it in either direction. So that, yes, that is a capital gain if it's in a taxable account.
Got it. What about dividends or distributions?
Both funds are required to pay their dividends and distributions as ETFs. If you look at ARKK, that has not paid an income. It's a very tax-efficient fund. We expect that the Diet series will have very low distributions. There probably will be a small distribution annualized, but not a massive tax as an efficient ETF.
What if I am 9 months through and I have to exit early? What happens then?
You can exit any time. So this is in the same way that you can come into the fund. The fund is trading every day for the course of the 12 months and then, of course, automatically continues. The same is true if you need to exit. And there's advisors or investors who are going to have a strategy of seeing where we've played out over the year, and they might reallocate to a new 12-month term if they've gotten what they've wanted, or based on a market cycle may allocate to ARKK and then come back. Again, it gives more tools. It gives more outcomes available for investors.
It's kind of like, this is a structured product that you'd get from an investment bank, but instead of having to go back to the bank and being like, please let me out, you can actually just trade it on the day.
Well, I think a lot of advisors who are watching this probably talk to salespeople for structured notes regularly. This is exactly what it is, except the difference is you have the full liquidity of the ETF and can trade out of it at any time. Or into it at any time. You have a series of 4 options, so you don't have to negotiate the terms. You don't have to pay a commission. You don't have to call the desk. This is a ticker. This is listed on the exchange. You can buy as much of it or as little of it as you want. I think it's important to remind that for all these ETFs, these have market makers that can make tight spreads. The traded volume on any given day is not the liquidity of the product. If you look at where the bid ask is and you put a limit order in there, you can get significant trades of significant sizes, even if the individual day is traded volume, because that traded volume does not equal liquidity. And again, that's because these are structured products. Again, a lot of advisors are probably using them across different parts of the book. This gives a liquid single-click ticker option and a number of different options effectively prearranged for you.
And you can find out more about it on the Diet Knowledge pages, or by Diet Knowledge base, including the fund pages and fund materials, which provide daily updated outcome ranges and more details.
The website has all of the information. It has tutorials as to how they work. It has where we are on the return payouts. And also for advisors, you can always reach out as well to your American Beacon sales rep or service as well. They are happy to walk you through a full tutorial or any of the ARK material online as well. So yes, we encourage you to reach out with any questions or if this is the first time that you are looking at a defined outcome or buffered product.
Okay, so what could go wrong? What are the key risks that we should understand before using Diet?
Well, the nice thing is that the risks are really mitigated by the ETF structure, right? The liquidity is there. There are market makers standing behind the product. The options are really based on the depth of ARKK. So the risk is really based in the reference asset. And in this case, it is ARKK. But of course, if it's to the downside, the risk is this is a mitigated product. If it's to the upside, the risk is that over a very long term, it's, we believe that ARKK with the full participation will outperform. But if you go through a prolonged choppy period, where you have, a drawdown period, for these shorter in between periods, it is likely that a defined outcome provides the protection that you want and then allows you to either reset or get through that turbulent period. So I think it really, the risk is, I guess there's always an opportunity cost as a risk. Certainly from the macro standpoint, the market could be negative. But again, that risk is directly being mitigated by what the product is.
And there's some, I guess people could potentially misunderstand how it moves relative to the ARKK because it's moving on the basis of where it is on the curve and all kinds of other things. So it's like you shouldn't expect it to the chart to look exactly the same as ARKK.
No, time. As you get closer into the 12-month term, because of the way options price asymptotically towards the end of the term, you'd expect that is much tighter. Now it does move. It's not like it doesn't move until that time. So there is moving. You'll see it up. You'll see it down. That's directly correlated to the movement of ARKK. So you're not going to see, opposite type moves, but you're not going to see them, in the earlier periods be exactly, in that participation rate on a day-to-day basis. But you will know where ARKK is into its term and what that means if the 12-month period were to end at that same place. And certainly if you're buying very early into the term, you effectively know what you're getting over the course of that 12 months.
Yeah. And so how do you know? It's like, I have a client, should I give him diet or should I give him the full ARKK sauce?
Well, I think this is the great thing about advisors is they know their clients. They know their time horizons. They know their risk tolerance. I think in terms of telling the client what they're getting, these are the same, right? Are you getting exposure to the most innovative companies in the world? Are you getting exposure to AI, to genomics, to autonomous robots? Are you getting exposure to fintech? And the answer is yes. Is that something that you think is important? Is that something you understand? Is that something you're underweight in your portfolio? Now, relative to the time horizon, relative to your market hypothesis, relative to your diversification, I think that's where advisors know their clients very well. And I think it's not a binary outcome, right? I think there's a lot of advisors who across their entire book will have some that are full ARKK and now have tools to put the rest of their clients into appropriately sized downside protected through diet. I think there's some clients that are going to have multiple of these funds within their own individual allocations. So I think that really is a question best answered by advisors because they do a great job understanding what their clients' unique needs and situations are, their own tolerance, their own time horizon. And we don't pretend to know that, but we've worked really hard to make sure you have a tool to be able to meet all of your clients' needs.
Yeah. I mean, the main thing for me is to get off your innovation short that you unintentionally have.
That's right.
And for some clients, that's been harder to do because they could be, the volatility can cause them to go back to zero exposure or effective negative exposure because of the risks to their small business, to their own life, to kind of like the core index holdings that are negatively exposed to innovation. This is a tool that allows them to have kind of a share of the platforms that should appreciate transformatively if disruptive innovation occurs in the way that we anticipate it's going to.
Well, I think 2025 is probably a very good illustration of this. I think that you looked at the beginning of the year, things were, the market was pretty happy. The market, there were clearly tailwinds at that point. You were coming off of the election. You get into April and Liberation Day and the tariffs, and certainly the market as a whole sold off, and longer duration assets, which obviously innovative equities are, and growth as a whole, underperformed for a period, and you clearly had a pullback. Now, from that point, the overall, all advisors and clients, or most all clients and advisors, certainly they started underweight innovation, which was effectively, as you said, inadvertently short. And even some of those who were longer, we'll say, maybe not real long, but longer on a relative basis, may have gotten spooked and, taken some of that risk off or what they perceive to be risk off. And since that time, look at what the market's done. There's been a little bit of volatility in here. There was some in the middle of the year. November certainly had some volatility. But when you look at innovation relative to growth, whether you say large cap growth or mid cap growth, when you look at it relative to the tech sector, when you look at it relative to the NASDAQ, the performance delta is quite stark. Now, I wish we would have had these products out, earlier in the year to say, if you're worried that this drawdown is going to continue in April after Liberation Day and the tariffs, well, you don't need to take it all off, right? You don't need to take this all. I understand that there's concerns. I completely get that. I understand some of your clients are really concerned. I get that too. This might be a good time to say we can't take this all off, but we'll cushion the downside over the next 12 months.
Right.
Or if there were clients who started the year, right? Let's say they started in January around the election. They said, I'm going to put a base allocation in. They get to April. They're feeling really good about the fact that they had they started off and they were probably wondering what was happening. They were trailing.
Right.
And then April happens. They were probably really happy. And they could leave it for the next 8 months. Or they could say, we've had a pullback. Obviously, we didn't know Liberation Day was going to come. Obviously, the market didn't know it. Look at January, February, March. Like, the market didn't know April was going to happen the way it did. But this is an opportunity. I'm actually now going to allocate into the full thing because I think this is the bottom.
Yep.
And that trade would have won twice on a relative basis.
Right.
So, I think this year is really a good example of the different ways this could be used. From that bottom, being short innovation has had a profound performance impact relative to pretty much any other growth.
Right.
And so, now there's a way where you can feel like I'm long that innovation, but if we have macro events or if we have geopolitical events, or if we're in we're in for some degree of chop, if that's what you think, if that's your market thesis, you can still stay invested with protection and then decide what to do from there.
Great. Well, I'd encourage viewers to talk with their advisor, review Diet fund materials, and really think about how Diet can allow you to stay fully invested in innovation across the cycle and across your full book of business. This is really the transformative decade. It's probably ahistorical in terms of the degree to which innovation is going to transform people's lives. And people feel that. They know it's coming.
That's right.
They know it's coming. And, that makes them feel nervous also.
Yeah.
And so it's really a hard job that advisors have to make sure their clients are looking out for their long-term wealth when they're feeling nervous about the world.
That's right.
And this is, we think this product fits in as a solution to helping them remain innovation exposed, even throughout that anxiety.
And I just think that one thing to really remember is you don't have to panic as to which one is right. You can use all of them. You can use ARKK. You can use all of the D, I, E, and T as the year plays out, as markets change, as we get into different parts of the cycle. They're automatically going to roll. So you don't have to worry about that. We want to make sure there's not this paralysis of, I don't know which one to choose, or I missed should I wait for the next one? Should I not?
But generally it would be like, hey, it's the first quarter, I'll do D, right?
That's right. I'm looking at my year ahead. I'm going to layer in a base.
Right,
I think ARKD obviously has a endpoint calendar year component to it that the other quarters probably don't have. Although I would say if you're watching this from an Asian market that has a different fiscal quarter, if this is obviously there are everything we're saying is true, and you can pick a different fund to start. But I just think that layering in a base allocation that you're not as worried about rebalancing, and now you're going to use ARKK to rebalance, or in some cases it's not right. Or if the fear is there, I think you said it correctly. Certainly when there is uncertainty, fear tends to express itself to the downside. But as these innovations play themselves out, after the world had its ChatGPT moment, there has to be some degree of fear of missing out a radical transformation as well, and having a very high opportunity cost. And again, when you look at a return profile that says in the case of a down 12 months, you're getting, market-like, again, based on the beta, based on there's lots of things that can happen. It could be better than that. It could be worse. But, just historically a more market-like return. But in those tailwind, in those growth, in those excitement years, you're getting mathematically much higher. That seems like an attractive base allocation. And then, maybe it's ARKK, or maybe you look at maybe you then can take a position to say, I think genomics this year is going to outperform, or I think AI and web and blockchain is going to outperform, and you look at ARKW, or I think this year is really going to be more about robotics and AI, and I'm going to go to ARKQ. So, I think that's the other way that this can be used, is perhaps your ARKK allocation becomes one of the diet funds, but that's not your entire ARK allocation, because now you have a thesis and you can play those based on where we are in the market. And I'd certainly encourage, look at the website, think through that. It could be a very positive client experience by doing it that way as well.
Great. Well, thanks for joining Funds in Focus. This has been a focus on ARK Diet. I hope you all enjoy its savory flavor and downside protection.